Welcome and good afternoon. My name is Jerry Frank and I'm the co-founder of STRATAFOLIO, and I'm going to be kicking off today's webinar. Everyone's goal is to have a successful investor relationship as you grow your real estate portfolio. And Jeff has some clear, actionable information he's going to share with us so you can do just that. We at STRATAFOLIO spend a lot of time with our customers and talking to a lot of different people in real estate. We hear and we see the struggles. And it was through these conversations and our own experience in real estate that we created STRATAFOLIO. STRATAFOLIO is an online software solution that connects to QuickBooks and provides asset management and automation for companies that own and manage real estate. We help you stay on top of your most critical bottom line impacting activities. And you'll learn more about why it's important to stay on top of your records and why that's truly key to investor management. Once again, my name is Jerry Frank, and I'm the co-founder and CEO of STRATAFOLIO. And we are very happy to have Jeff Engstrom with us today. Jeff is a senior advisor associate with Hall CPA, which is commonly known as the real estate CPA. His firm specializes in working exclusively with real estate investors, developers, and real estate fund managers. They are the experts. But not only has Jeff worked extensively in controller CFO roles for his real estate investors and developers, but he himself is a seasoned real estate investor. He has seen both sides of the wall. He understands the value of solid financial reporting so you can make sound business decisions and yet minimize your tax burdens. So with that, I'm going to turn this webinar over to Jeff so he can get started.
Thanks, Jerry. My name is Jeff Engstrom. As Jerry mentioned, I'm a senior advisory associate with the Real Estate CPA. Today, we're going to go through just a handful of things that will kind of help you streamline some of your budgeting processes. And what I'm going to do is I'm going to kind of tie this all into how the underlying accounting records really drive what's important in terms of your budgeting practices, understanding revenue and cash flow, managing and tracking your Capex expenses and ongoing operational or maintenance expenses. And then also how the lease renewals and escalations play into kind of the overall revenue picture as well as budgeting and all of that. So first we'll start with the budgeting practices. So first we'll start with just maintaining proper budgeting. And then I'm going to kind of go through a few things that will impact why that's important and why the underlying accounting controls have a lot to do with how the budgeting is impacted. So first, what I want to talk through is some of the things that can happen if proper budgeting is not put into place. So in some cases, you'll run into obviously substantial cost overruns. So by that, I mean, if you've got one example of this might be if you're budgeting a certain amount per month, let's say for your water bill, and you've got a proper budgeting process in place, what can sometimes alert you to the fact that there may be a problem is, for example, you may see a spike in your water expenses. With having a proper budget in place, this allows you to basically spot variances that seem to be out of the ordinary. So that's one example. Another thing that helps with having a proper budget in place is, again, recognizing abnormalities and certain spikes or abnormal or unusual transactions when compared to what the budget otherwise would have been. If you don't have this in place, sometimes that can lead to potential fraud or fraudulent transactions to not be detected. By simply going through the motions each month of preparing a budget to actual analysis, that alerts you to those types of transactions that you may not otherwise know as something that is the usual recurring expense for the property. Sometimes without proper budgeting in place, this kind of ties back into substantial cost overruns. This can put you as an investment sponsor in an awkward position such that you may have to go back to your investors for additional capital calls. That can create some problems in terms of the investor's confidence in the project and what you're doing. Having to go back to them to ask for an additional $50,000, say for example, because the budget wasn't properly adhered to, can obviously get a little awkward. So one other thing too that, again, I pointed this out earlier about the water bill. something for, like otherwise high operating expense that normally is abnormally high is something that is easy to spot, obviously, if you're paying attention to your monthly budget. And what I've always seen happen is people prepare a monthly budget to actual analysis with actual narratives, out, and you can set sort of a certain threshold or percentage. You can simply say, if this particular expense exceeds the budget by X number of percent, something like 5% or so, that requires or deserves some sort of an explanation. Because in some cases, it may be, it may be something that there's good reason for it. Maybe if it's a repair cost or a unit turn cost, it might be a situation where that month you just simply had a lot of leases expire and a lot of people move out. So that generates a lot of recurring expenses to turn those units over and get them prepared for the next tenant. Here's a couple of things I want to just kind of outline that can help with that. Having proper accounting controls through expense approvals and things like that are always good internal controls to have in place from an accounting standpoint. The reason this could matter is, you may have a situation where maybe you've got an on-site property manager who is in charge of preparing orders with vendors and having repairs coordinated and things like that. By having those proper accounting controls in place, this requires oftentimes a 1 or 2 step or even sometimes 3-step approval process, such that the particular property manager, say for example, on site, maybe is not allowed to have vendor purchase orders put into place that might exceed a certain dollar amount, for example. Those are all things that just kind of allow you to keep tight control on the accounting process. And obviously that, again, you'll hear me refer oftentimes back to the accounting process, simply because the underlying accounting records is what drives the entire budget process. Again, this is, I mentioned also preparing regular monthly budget to actual variance analysis reports with narratives. And so again, what that does is that basically that explains, and oftentimes, when you have to send these reports out to investors, some investors may ask a lot of questions, some might not, but oftentimes I've found most investors are pretty sophisticated and they know what they're looking at. So, and some of them actually do spend a lot of time combing through the reports. And if they see abnormally high expenses, over certain months, that's definitely going to bring questions. Oftentimes you'll see what's called a trailing 12 profit and loss statement, which basically has each month over month, every single line item in the profit and loss statement. So it's easy visually to compare month to month those various costs and expenses. So if, say, for example, the month of June has a really, really high water bill, like I mentioned earlier, compared to May, you might want to start asking the question. However, sometimes, again, there could be a logical reason for it. Maybe you're in the state of Arizona and it's 118 degrees outside. And, so naturally those bills are going to spike certain times of the year. So something to keep in mind, definitely always prepare for your investors a monthly narrative that explains some of the spikes or otherwise unusual transactions. So this is just kind of a layout or an example of what it could look like. Oftentimes these will take kind of the form of a wide variety of different formats. So you'll see in the beginning there, obviously gross revenue is the rents collected. And this is in one format that might not be exactly the same as the next one you might see, but in general, overall, you get to the same number. So you'll start with gross revenue. And in some cases, people will actually back out whatever vacancy loss you might have and impute or attribute a certain dollar amount to that lost revenue. So if you've got, say, 2 units empty and the total of those 2 units per month for rent is, say, it's $5,000, that's in theory a loss of $5,000 in potential rent. Below that, you'll see just all the various operating expenses until we get to net operating income, commonly known as NOI. Below that, we'll have additional capital expenditures. And capital expenditures, we'll dive into this here in a second, but they can be funded in a variety of different ways. Sometimes you may have a separate Capex fund that's pre-funded at the time of close, such that you'll draw down on those expenses as they're incurred or as the project, as it takes its form. Sometimes those will be funded by bank financing. In that case, you'll have a specific set amount by the bank up front that will say, okay, we'll allow you to borrow, say $1 million, for example, over the course of this project's life or during the Capex period, whatever time period that might be. The importance of solid financial records cannot be stressed enough in a case with the bank when they're involved, because oftentimes the bank will require those financials to be pretty pristine. So, and I've seen cases where banks will simply stall or delay funding to keep the project moving if the financials don't meet their requirements. So that's extremely important. So beyond that, you'll see total cash flow from operations. So that's essentially net operating income plus any of the capital expenditures. And then below that, you'll see debt service. So that's obviously the mortgage payment. So principal and interest on the actual note securing the property. And then below that, final total cash flow, $116,930. So this is just an example. These are arbitrary numbers, but this is just kind of the flow or the format that you sometimes may see this in. So here's a handful of things that can create some problems if you don't have good accounting procedures in place. So obviously the commonly known one would be simply just lack of clarity as to how the property is actually performing, lack of proper checks and balances. This kind of ties back into what I mentioned earlier about having like an approval process. Possible subjection to audits. This can get really tricky, especially there's obviously a number of different types of audits that can happen. One might be an IRS audit. Certainly not people you want to mess with. The other one, sometimes, depending on the financing structure, certain banks will require an annual financial audit. So just truly an audit of your financial statements on a yearly basis. The other thing too, I mentioned earlier, lack of investor confidence. Again, there's a lot of investors that are pretty seasoned in investing in various projects, and so they know what certain financial statements should look like, and they know what to look for. If they see financials that come out on a regular basis that are not well put together, not clean, it creates kind of an awkward situation with them. Difficulty with bank financing. I talked about this a little bit ago in terms of doing bank draws. Banks, again, are also very, very picky when it comes to financials looking a certain way. This bullet point is an interesting one, low confidence in potential buyers. Sometimes when buyers are looking into purchasing a new property, the seller will provide previous year's financial statements just to indicate or show this property performs well, it's got good rents, its operating costs are low. Obviously, if you don't have solid, reliable, readable financials, this can create issues if you're ever trying to sell a property. Likewise, on the flip side, if you're ever looking to purchase a property and you're looking at financial statements that may have been provided by the seller, this can also create sort of misleading or issues with developing a solid pro forma. One of the parts that's always, in my opinion, this is sometimes maybe the funnest part about buying new properties, is putting together kind of the pro forma and going through what the potential property performance may look like. What can we get in rents the first year? How can we decrease operating costs? Things like that. Again, obviously, if you don't have solid accounting records underneath that, it creates a very difficult situation in terms of a good basis to start with. One thing I think that is always helpful in any accounting setting, both whether it's a matter of preparing financial statements on a monthly basis, or we even use at our firm, we use checklists every time we prepare a tax return. And it's just simply something to jog your memory and to check a box and make sure that you're not missing all of the relevant pieces and any critical things that need to be identified or handled, especially in a tax return. So that's one thing that any solid accounting department should always have, is a procedure manual that outlines step by step for all of those people involved, whether that's the people doing the work or even somebody reviewing the work, just to make sure that the work is actually done in accordance with the procedure. This is a big one, developing the proper chart of accounts and the procedure for properly coding expenses. So this is in an accounting set of books, you've got an account for every single little thing that both hits the profit and loss statement as well as the balance sheet. And having these properly set up for the correct industry is critical. For example, a dry cleaning business would not have the same type of chart of accounts as, say, a real estate investment portfolio. There may be some that are similar, but most of the time it's going to look a little different. This is incredibly important to make sure that the financial statements are readable by the investors or anybody for that matter. So again, having the procedures in place to make sure that the expenses are coded correctly is always a big one as well. Completing monthly bank reconciliations. This is a huge one. This essentially ensures that every single transaction that goes in and out of the bank is captured in the financials. This is something that also ties into properly coding expenses. Oftentimes I'll find in looking through bank reconciliations, sometimes an expense might be coded incorrectly. Let's say, for example, you had a utility bill that came through and somebody maybe mistakenly categorized it as a bank loan or something like that. So this is always a very good thing to do. It's just a good habit to be in as well, because it always ensures, again, that every single transaction that went into or out of the bank is accounted for. This is another one. I'm reiterating this one again, as I mentioned earlier. Having proper internal controls and approvals for payments and things like that, that is absolutely critical. And it oftentimes can help as well as in terms of preventing any kind of fraudulent transactions. It's never 100%. There's never a guarantee that fraud cannot happen, but it definitely can help to hedge against that. Next thing we want to talk about is cash flow. And really this is a huge one as well. This is kind of another example of what a financial statement may look like, starting with gross revenue. You have all of your operating expenses that gets you to your NOI, net operating expense. We threw in a Capex expense here, something like a roof repair or something like that. Typically, now keep in mind, these are just arbitrary example numbers. Typically something like a capital expense will typically be something that exceeds $2,500. $2,500 is the de minimis threshold dollar amount outlined by the IRS in terms of tax deductions. That's oftentimes used as kind of a general rule. In a case where you've got actual audited financial statements, that number is actually 5,000. So essentially what that means is you're able to deduct that in the current year as opposed to capitalizing it and classifying it on the balance sheet, which then requires you to depreciate it over time. So that's another subject that we'll dive into here in a little bit in more detail. Tracking Capex expenses versus operating expenses. This is oftentimes a very confusing area. Things like painting, inspections, routine maintenance, landscaping, utilities, those types of things. Those all fall into the operating expense category because those are just general expenses that typically happen as a monthly recurring expense. Capital expenses are things like a roof replacement, maybe appliances, repaving the driveway, the parking lot, maybe replacing an HVAC unit, flooring, plumbing, those types of things. Anything basically that adds to the structure of a building or property. This can get a little bit confusing, and this is a little bit of a gray area in that sometimes it could be one or the other. And I'll give you an example. Something like an appliance, for example, might be maybe you've got a 300 unit apartment building and you're buying 300 stoves or refrigerators. That's probably going to be something that is capitalized to the balance sheet. On the flip side, that could also be something that may be expensed. If let's say you've got to turn 1 or 2 units, some tenants move out and you're replacing those stoves, and maybe you buy them for $600 a piece. That's something generally that could be expensed right away as just a simple turn cost or an operating expense. Obviously, improper classification of these things can have a huge impact on NOI and or tax implications. So, and the reason for that is the interplay between the profit and loss statement and the balance sheet will change the net operating income number. So back to the example of the appliances, if that's something where you're capitalizing that and you're putting it on the balance sheet, now you're effectively removing it from that bottom line net income number. And the reason that changes is because you're now putting it up on the balance sheet and not taking it as a current month or current year expense. And instead it's being capitalized, which means for that particular asset, you would be then depreciating it or recovering that cost over the appropriate class life. In the case of an appliance, typically they're usually 5 years. So you'd be taking 5 years to basically fully recover the cost of that appliance. The last one's going to be tracking leases and renewals. And the reason this is something that we thought might be helpful is oftentimes a lot of investors will simply they'll have, maybe they buy a property and there's already leases in place at a certain amount. Sometimes maybe they're not paying attention to what the market rate is. And so say, for example, you've got a tenant in unit 1 and they're paying $1,000 a month. Maybe the market rate for that unit might be $1,500 a month. Obviously, that's a huge opportunity cost over time. The one thing that you can get into trouble with that is there's an opportunity cost that reduces the ROI to your investors. In some cases, that can create sort of a loss of visibility as to which units are vacant, which ones are down, things like that. Some solutions to that might be just, considering having some sort of a tracking mechanism or a process for doing market comparisons to ensure that you're charging fair market rates for rents. There's a number of ways to do this. There's a couple of companies out there. There's one called YieldStar. I think they're actually owned by RealPage now, but it's an actual software that is put into place that tracks market rate rents in, I think, all the way down to zip codes. So what they'll do is they update every day and they tell you, in this particular zip code, a 1-bedroom unit should be, the market rate might be $900 or whatever that number is. So it's something that allows you to have some visibility as to what your competition is. Sometimes people actually go out and they shop their competition. So if you have an apartment building on 123 Main Street and there's 5 other ones in the same general area, sometimes people will actually shop other rents or other comparable properties. There's a number of companies out there that have lease tracking software. STRATAFOLIO does that. Something that maintains lease details and remainders for upcoming lease renewals. So just in summary, we talked about budgeting practices. We talked about accounting records. Accounting records, again, are absolutely critical to having solid, reliable budget numbers, understanding your revenue and cash flow. And finally, tracking Capex and maintenance expenses.
All right. Well, thank you, Jeff. So you're probably wondering, what does STRATAFOLIO do? And thank you, Jeff, for the shout outs. We do help owners every day to be more accurate and responsive to both vendors, investors, and lenders. And our product has been used in board meetings, in financial presentations to lenders, and even as a resource for answering the day-to-day questions. STRATAFOLIO can help you with cash flow management so you can see your global cash flow or isolate to a single company. Debt management for your portfolio, including key metrics like debt coverage ratio or loan to value. Lease management, so like Jeff was mentioning, you're alerted when those lease bumps are coming, and we can help you with CAM reconciliation. And investor management, tracking who is involved in every deal, their ownership, and their portion of the debt. And now we have work order management. You can track when your work orders were requested, dispatched, and completed. Thank you for joining, and don't forget to follow us on Facebook, YouTube, Twitter, and Instagram so you can learn about other exciting product announcements and educational programming as well. Take care. Thank you, everyone.